So yeah, just a provocative statement to start it with. So this graphic, I'm just going to start with this one because I think it's a nice way to look at it. Obviously, we're looking at 12-month rolling. We're finally at a situation where we're starting to see some stabilized numbers in Europe from a profitability perspective. And what I've done here is just plotted on the bottom half of the graphic. So on the left-hand side here, you have the GOP margin change, and on the bottom you have the TREVPAR change. So those on the right-hand side, which is the majority of the markets that we're looking at here, have seen pretty significant growth. You have still some lagging behind the 2019 levels on a 12-month rolling basis. But actually, not many of them are above the improved GOP margin line. And I thought it was an interesting starting point because although we are seeing pretty significant revenue growth, there are still quite a few markets that are quite far behind from a profitability point of view. And that's driven by, of course, pretty significant cost increases. This is Europe macro level, so obviously we're all dealing with similar challenges, albeit that it varies by market. You know, energy costs has obviously been a challenge. The return of some of the undistributed expenses that I think we stripped out during the pandemic, and of course the rising costs of bookings and the related supply costs. And the biggest issue, of course, is the labor costs, because as we see high levels of inflation, we also see high levels of increased costs of labor. And I just took one part of the P&L, which I thought was interesting. This is definitely the hot topic at the moment. It's an area of the business that we haven't seen such inflationary increase in, which is the area of food and beverage spend. So customer spend is up slightly, but it's not up anywhere near the size of the cost increases. And in fact, if you're in Northern Europe, if you're in Germany or in the UK, for instance, you're very unlikely to be making very much money from your food and beverage outlets as things currently stand. Because as you can see here, the left-hand side is basically the profitability position of food and beverage now, and the right-hand side is where we were in 2019. Some markets have seen over 10, 12 percentage point drop in food and beverage margin. It's pretty shocking, which is why I started with this slide. And on that note, I'd like to invite my panelists up. So we've got Erik, Webb, Dempsey from Julius, Meinl, Living. I think I said that right. I'm going to try this one. So we've got Borivoj Vokrinek. And hopefully we've got Andrea Bastel as well from UBN. So if you don't mind taking a seat. You should all have a microphone. Yeah? So I guess the best way to start is if everybody could just introduce yourselves better than I just did for you. Andrea, if you don't mind starting.
Sure. Hi, my name is Andrea. So I'm with UBM for 6 years now. I'm responsible for our lease portfolio in Austria, Germany, and the Netherlands, and also overlooking our development of the entire hotel portfolio, in short.
Okay, great. Erik, if you don't mind.
Yeah, I'm Erik Webb Dempsey. I'm American by origin. I've been in Prague since 1993. I am responsible as Group CFO for Julius Meinl Living. We have the Julius, which has just been completed last year. I always have to point out that it's across from the DACH. So if you're doing the tour, look across the street, that's us. Yep.
And the Anders is ours.
Right.
And Borivoj, I don't know how much of an intro you need, but...
I hope not much. So my name is Borivoj Vokrinek, so good luck pronouncing it.
That's what I said,
I am almost. Was working for Cushman Wakefield, hopefully no need for introduction. I'm responsible for strategic advisory and research in EMEA. So obviously research is obvious, strategic advisory is a little bit terms that is not easy to understand, so there are actually 3 chairs hidden there. I'm responsible for advisory for anything that is outside the box, not valuations, not operator selections, not transactions, anything complicated. We do advising investors on their strategies, or City of London on their spatial distribution of hotels within the city. Then I'm responsible for asset management, coordination across Europe, and as well specifically asset managing hotels in CE. And the last but not least, I'm coordinating sustainability between we have army of engineers and BREEAM certifiers, etc. But they don't have the hospitality expertise, so I'm the connecting dot between our teams and our sustainability teams.
And you're also a tutor at the hotel schools as well, so yeah, Chief Everything Officer as it is.
Yeah, and I'm teaching, yeah.
Good. All right, look, the question on hand is inflation good for hotels? And I think the starting point would be, Andrea, I guess if you don't mind starting, there's going to be nuances to this, I'm sure. But can you give me one reason why inflation is good for hotels, and maybe one reason why inflation might not be so good for hotels?
Okay, so the good point, definitely, I think that's an easy one, is just ADR increase. So now is the time, let's say, to push ADR. So definitely that gave us a very good opportunity to revise our top line, let's say. Counterpart is, of course, cost increases, so really protecting profitability. Okay, it's just one point. So I say, TUP profitability.
Okay. Erik, for you?
In terms of what's good for hotels, is inflation good for hotels? I would say yes, because of assets. And that's related to profitability. So generally, the hotel profitability generally will outpace inflation. The answer is also for no is also asset value, because in an inflationary environment, we have the central banks that naturally tend to increase interest rates. In an interest rate environment, that tends to suppress or increase yields, which suppresses value. It's generally offset, so we'll debate today whether the big balance is higher growth and profitability versus higher growth and yields. So how they balance out is really the yes or no in terms of increased value.
Interesting start. And Borivoj, anything to add?
So I will put sort of the asset manager ahead, and I think it's good for hotels because it makes hotels look better in relative terms against other asset classes that are less are more sensitive to inflation. So that's good. Obviously, what is bad is not necessarily the inflation, is what governments and institutions do about it. They try to control it and increase interest rates, which obviously is not ideal for owners who have variable interest rates or who want to finance transactions. So that's not that great. But that's the same problem for hotels, offices, or shopping centers. There is no discrimination there. So overall, I think hotels are winners there.
Yeah, I mean, I think we've generally stuck to the operational performance side of it based on I think the comments you've raised so far. I mean, the revenue perspective is an interesting one, isn't it? Because obviously there are way more dynamics to hotel pricing and hotel performance than just inflation, right? There were so many factors, and a lot of the slides I showed then, the impact of other factors like the pent-up demand or things that came out of the back of the pandemic. There's obviously quite interesting to look at, because the reality is post previous crises, generally we led by occupancy, it was demand the return, and then we were chasing pricing. And in fact, for many markets, it was a race to the bottom because you had to discount in order to be able to maximize demand. That hasn't been the case this time. Do you think inflation has helped us with that, Borivoj?
I think yes. I think that across all sectors, I was fitting out my apartment and I was going to shop, and the shop assistant was changing the prices right in front of me, right? And the classic excuse was, I'm buying, it's more expensive to buy, so I need to increase. He was increasing by 40%, so I suspect his cost didn't go by 40%. So, but it's a good excuse. People are willing to increase the prices because they hear it in the news, and it's across the board in the shops and in the hotels, etc. And as well, the wages are growing. So I think what is unique as well here is that we have very low unemployment. So people are not sort of worried about their jobs, and they keep spending. There's the savings, etc. So that certainly helped. And I echo you that what happened. I teach obviously the typical cycle behavior, occupancy first, and ADR following. It's a miracle what happened, right? The ADR growing and achieving actually higher revenue with lower occupancy, even from sustainability perspective.
Yeah, I mean, one of the factors was obviously we took
Amazing.
a total reset, right? A lot of these markets closed completely almost, and then we've almost been able to reset. I think the luxury segment has come up a few times today as a great example of it. Over the years, relatively, rates have slowed, and of course, we've saw this repositioning. Erik, you obviously sent me this graphic earlier in the week, which I thought was, unfortunately, we weren't able to include it by now, but I thought it was interesting as a topic that, the way that hotel performance relates to the general inflation, and not just follows it, but maybe you could explain just a few points of what you found there.
Yeah, when I was asked to speak, I started looking at the topic because intuitively, I've always felt that ADR inflation, hotel hospitality inflation, outpaces headline inflation, and particularly core inflation, which excludes energy and food. But it was actually remarkably difficult to really kind of find like a data set. So I came up with my own. But basically, I can just hold this up here. If you want to see it, come speak with me after. But basically, the hotel and food and restaurant HoReCa inflation outpaces CPI and core inflation by about twice, and it does it almost across the line. I measured between 2013 and 2019. It's about 2 times the rate of growth in hospitality, let's say call it the revenue or pricing, ADR. So it's definitely growing at a faster pace than core inflation, and we'll touch on the operating side.
Yeah, I I think the point on the revenues is the one thing, because we do outpace inflation. It's it's wonderful news for hoteliers, and it makes it a very interesting asset class for sure. But Andrea, of course, the other challenge is that costs also outpace inflation, and that's a challenge for us.
Definitely, and what we've seen is that we also have seen the price increases, cost increases throughout the year. So budgeting, so actually the budgets that we made, last year, end of last year, they're just not valid anymore. So you really fully need to redo your forecasting. You need to check every single cost line and be actually a harder negotiator also with your suppliers, because they will just send you a nice little letter stating, okay, we'll just increase by whatever, 20%. So I think it was especially a challenge for our hotel teams on site, and being kind of attacked from various sides. So yes, of course, you push top line, and everyone is like, yay, we pushed top line, and then you said, yeah, but you have payroll increases, especially if you have them, by government, so you need to implement them. Mainly it starts, with the line staff, and then your whole payroll structure in the hotel all of a sudden is at risk. So you have supplier, you have your payroll, so the cost was definitely an issue. Not mentioning energy, because that's another big thing, yeah.
Yeah, of course.
Yeah, I mean, I agree, but again, putting the asset management hat on, I think what is unique about hotels, and that's why, many investors, once they get a taste of it, they stay and they buy more, is that hotels have a high operating margins, right? We're talking about 30, 40s, extended stay, over 50%. So, for example, if you have over a 50% margin, your cost would have to grow twice as fast as your revenue in order to actually nominally start reducing your GOP. And that's the beauty, that hotels are actually, one of the most profitable businesses out there. Many industries have 15, 10% margins. So the moment inflation starts eating into costs, they are in trouble very quickly, versus hotels, thanks to the margins, thanks to the lower base of the cost, labor cost grows, but energy goes. But energy was 3%, 4% of revenues, so now it's 8%, doubling, but still it takes 5% of the GOP, but the revenue growth compensates. So
I mean, given that we are a lessee, we also see the lease, after GOP, and this is kind of killing then the argument, because our leases have increased significantly given the indexation we do see. So this is why profitability is not where we've been in 2019.
Great for owners.
Yep. But I was just last week at a discussion in Germany, and then, the lessor was like, yeah, we have just an 85% indexation, whereas in offices you have 100%. So then also, as an operator, you say, look, maybe, but it still is enough to get being challenged, let's say.
But I think you made the point on the budgets, right? Which is obviously trying to keep in context of what's going on in the market, especially if you see, inflation moving at such speeds like we have done. Like I guess in Northern Europe and Western Europe specifically, we've probably not seen for a long, long time, right? This kind of level. So trying to keep to grips with that as we're going through the year, is already one challenge. But on your point of lease agreements, I think this is another interesting topic, right? Because you base your rent on the previous year's CPI. So as we go into next year, if inflation slows like it's expected to, you're going to have been basing the lease payments on what is significantly higher. I mean, I guess you must experience that through the clients you're dealing with.
Yeah, I mean, obviously that's a big challenge. Obviously, it's always from what angle you're looking at it, right? So hotels can change the pricing and revenues constantly. So they benefit of increasing revenue while the cost stays, right? Whether it is rent or salaries. I mean, unfortunately I see very rarely employers increasing the salaries the same day the inflation goes up or the prices go up. They say, okay, next salary review, which is obviously March next year, right? So there is that sort of benefit of increasing revenue earlier and faster, but then later on, managers complaining, our costs are growing faster than revenues, but you have to remind them, well, last year
had the benefit of it
was the benefit.
relative,
So
On wage inflation, I think it's interesting. So we have a hotel in Hungary, and we gave everybody a 10% raise. Well, inflation in Hungary is actually closer to 20. And then even more interesting was when I was looking at the 2022 results. I know that we raised wages by 10%, but in euro terms, the actual cost of labor actually decreased by 10% because of the adjustment to the forint. And that's the way economics kind of works. In a high inflation environment, you give people a 10% raise when the inflation is actually 20. People go, great, I got a 10% raise, but in fact they got a 10% decrease. But most of the people don't really study the economics well enough to rebel against that.
Yeah, of course. But how do you judge the operational performance of these hotels? I think when you have the challenge of, some of these, it's kind of relative change. So you were talking about energy costs there. Maybe it is double now, so it's gone from 4 to 8%. But labor costs will have also changed that margin by 2-3%. These are real challenges to kind of compete with because they are inflation driven, and yes, they might lag behind a bit. There's got to be a cap. There's got to be a limit to how much you can continue to drive the top line, surely, Andrea?
Yes, there is. I mean, we don't tell our GMs for the budget, but we do see that last year and so in 2023, we had the opportunity to really push rates because everyone was accepting it. Now comes I think 24 will be the year where we see that especially corporate accounts will not accept the increases that we've made last year. So what we're pushing now is to go to dynamic rates rather than fixed rates, to also be able to react to inflation so that they're really on the variable side. Cost perspective, it's difficult.
Yeah, I think overall, I mean, we had this discussion a few weeks back, right? Where you have there's almost like a circular relationship between the cost of building a hotel has also gone up significantly, which has limited the supply, which in effect has then driven, it's kind of compressed demand, right? So you have a real relationship between those things. Do you think strategically now that's changed things for hoteliers, Borivoj, on how the decisions developers are making on what hotels to build, how to build them? Has that changed because of this increase in building costs?
Well, yeah. I mean, usually the decision is not to build because it's just too expensive. We have done survey among operators, and there is a substantial delay and cancellations in hotels, which is a good, especially in inflation environment for current owners, because you have a constrained supply. So you have constrained supply, you still have a demand that, as Danny on the day one said, there is still savings, and so it's a perfect situation for hoteliers to continue raising the rates, and I hope they will. And coming back to sort of there is a limitation on revenue growth, and obviously the ADR, you cannot raise it forever, but there is still quite a big gap on occupancy in many markets. So while maybe next year and this year there won't be as much ADR growth, but there will be occupancy growth. That comes with more expenses, but still, if you look at the markets, the chart you had, and I have done similar analysis, you know, there are, out of 11 markets that we monitor, 6 as a positive GOP. You know, some of them above 20%, Paris above 60%. GOP increase per available room, that's not percentage.
So Paris also, just to clarify on the Paris one, for anyone who saw that on the slides and on this topic.
It's insane, right?
Yeah, it is, and it's relative to 2019, because what I pulled out the data originally, I presented it at the beginning of last year, and actually a lot of that change was because in 2019, the first half, they had this, the protests, the Yellow Jacket movements there. So there is, the base is slightly skewed, but yeah, of course, it's phenomenal. I mean, the rates are up 30-odd%. You're seeing, you know, significant changes to the cost base, because I guess for the first time, hoteliers were able to strip out some of the operating costs, right?
So we will have payroll, but energy is coming down.
Yeah.
Right. So there are positive trends. The cost of goods is coming down, right? Food, etc., is getting cheaper already. So I don't see that negatively, and I think hotels really benefited from this kind of unique situations where we have lots of compression demand after. And we didn't have to, you know, last time around from 2008 to 2000, it takes 7 years, some market 8-9 years before ADR came back to the previous levels. We are there in 2 years. It's incredible.
Yeah.
I would just mention, you know, again, doing my own calculations in the market I know best, which is Prague, right? So I was looking at 2013 to 2019. So the euro inflation would have been like 0.9 CAGR, compounded annual growth. The Prague market ADR in euro terms was 4.1 in that same period. So, okay, so you get to raise your ADR, but then the argument is how high can you raise it before your occupancy decreases? So for that, you look at RevPAR. So the CAGR on RevPAR was 6.2. So that implies, argumentally, but at least between 2013 and 2019, that even though ADR was rising, it was not pressing demand. Now, of course, you know, it's a bumpy road, but on average, there's anecdotal evidence to say that the market can.
Yeah, and also I think some of those numbers are slightly skewed because the RevPAR growth has been pretty phenomenal. It's been driven by average rate, and of course that's great news for all of us. But actually, from a TrevPAR perspective, from a total revenue point of view, you know, actually it's more like 6%, right? It's a lot lower because the speed of growth in other areas of the business, or even the loss of revenues of like conferencing that has really seen a slowdown, is of course, you know, a significant challenge. And at the same time, the fixed costs are going up. So you're paying more for insurance, you're paying more, I'm going to assume you are, because I see from the data we are. We're paying more from, you know, service contracts and some of those fixed expenses. And we actually managed to strip out like 30% of our costs, the fixed cost during the pandemic. Yeah. They've returned, as you could sort of see from the slides there, right? But I'm not sure hoteliers have now brought all of those expenses back into the business. I think just everything is costing that much more. So you've actually got a lighter model. You've done all of the work to strip it out. Can you imagine what state we would have been in now if hoteliers had gone through that process proactively because of the pandemic? We would have been, you know, we might be looking at 30% increase in costs above and beyond what we were paying before. So basically, we would have stripped out any chance of any kind of profit. I guess we should touch on investments now, on, you know, what that's doing to your modeling for investments. I guess, Erik, I'll start with you. What's changed now from your planning process? I can imagine.
Be careful, you're opening very, very big topic for Erik.
Yeah. Well, yeah. I mean, we're a developer, owner, and operator, so we take the whole chain. And so when it comes to acquiring new sites, and the risk of what do you pay, you know, when you're valuing a site, you take the residual value, which is basically the present value of the on completion minus the purchase price, minus the development cost. Now that's the big thing. You know, can you really accurately predict what your total project costs are going to be in 3 years, 5 years, you know? So that's a significant challenge. And on top of that, because of the interest rates, if you're leveraging the buy-in, you know, you cannot afford to have permitting delays. You know, so the cost of a permitting delay substantially increase your cost of financing.
And I guess interest rates play a fairly big part in that. Andrea, got anything to add to that?
So now I'm taking my developer hat on because UBM is also a real estate developer. So interest rates are playing a big role. So if now, last week, just the European Central Bank again increased the interest rates. And the last couple of months just gave such a planning insecurity. And we are a pure play developer, so we're not actually holding our real estate. So we want to making forward deals. But what is the forward? Because you don't know what your project costs will be, what the interest rates will be. So you're really struggling with actually pinning down a yield that you can underline. And I mean, you can save whatever you want in your construction costs. 0.5% in yield does, is the kind of the key player. Yeah? So this gave us quite a hard time in the last couple of weeks and months to really decide on projects and bring projects forward. Also not getting offers from construction companies because they also didn't know what the cost base will be. So a lot came together. And now we see it a bit, that it's getting a bit easier with construction pricing. Hopefully now also that maybe there was the last adjustment of the ECB. So let's see. We're hopeful.
Yeah. Do you think? I mean, sorry, we're running out of time now as well. But Borek, I guess that just going back to the whole, does it make lease agreements more attractive? Does it make the model of buying and selling hotels kind of change things? Because I guess in some ways, the idea that you're going to take maybe a 3-5 year view on buying and selling a hotel, the exit strategy changes completely if you're looking at these kind of high levels of interest rates and what that will mean to residual value, etc.
Right. So obviously these agreements are, again, it depends. Obviously, if you negotiated the lease agreement at 2019 on the at the peak of the cycle and your lease is at that
depends
level,
when you start. I guess
you are
point,
basically in big trouble now. As a tenant, as a landlord, you're laughing. Obviously now, funny enough, obviously everybody burned their fingers and they don't want to do leases now, especially not fixed leases. But it's actually a good time to do fixed leases because the basis is still reasonable, and we are going obviously upward. So it's going to be more and more difficult. However, from investment perspective, and Maksud actually mentioned it during his keynote, the mathematics of the deal are difficult because of the financing. Usually your rental level, your yield is just not sufficient, and the expectation of the buyers, of the sellers, are just not. The gap is too big between what the yields would be and what the cost of financing is. So the institutional investors that are usually buying fixed income type of things, it just doesn't work. So that's why we have the variable income, variable leases, hybrid leases on the rise, because there it helps to deal.
And they were on decline, yeah. So it's kind of changed the curve a little bit, maybe.
Yeah, well, it helps to deal with the ambiguity, right?
Yeah.
If the tide will go up, both the owner, the landlord, and the tenant will benefit, right, of that. And if not, then there is some sort of space to reduce the rent because of the variable component. So that's more kind of fair structure.
All right, so I guess the answer to the question, because we're just nearly out of time now as well, we are out of time. Just on that point, because I think it's a really interesting one, because I think the crux of all of the conversation we've had here, and I kind of expected this would be the case, because it's a very complex subject. It depends on the situation you're in, the timing, how well leveraged you are, which market you're in. There are lots of different factors for it. But if you're going to pick one, Borek, what would be your kind of, in which situation, as an example, would inflation be really good for your hotel right now?
Well, I would say if it is a luxury hotel with good margins, right, because then the mathematics works, constrained supply, and still strong demand, which is actually where we are now. Luxury hotels doing well, good margins, constrained supply, demand, luxury demand is still strong there. One more caveat is I have refinance and I have a fixed interest rate.
Yeah, okay, yeah, fair enough. Erik?
Yeah, I mean, I think the situation, with interest rates increasing, I mean, the main reasoning for central banks to increase rates is to actually reduce employment, but that's actually not what we're observing. I think we've got a shift. We've got a shift in terms of whether values should be going up or down. The cap rate has increased, but so have the EBITDA in nominal terms. But I think values are not going down because you can't get bank financing. It doesn't make as much sense to leverage a deal, but we talked earlier, there was about dry powder. So I think we'll see a different type of investor coming in. So instead of those that come in and buy very high leverage deals, those guys will probably go away, but there's new buyers that come in that are less reliant on debt. And those guys will benefit because if they can come in with equity, sit on it for a couple of years, wait for the interest rates to go down, they have a chance for an upside.
Yeah.
So
interesting. Andrea, quickly for me.
I'm pretty much actually with Borivoj, but I would change from luxury to rather mid-scale because you can really push rate. You have a lean operation where you also have opportunity, usually also to come back to the panel before, to support with technology, online check-in and so on, and hopefully with a cap on indexation in your lease agreement.
It's definitely, yeah. No, year-to-date performance actually is the mid-scale segment that has seen the largest growth in profit margin out of all of the categories. So yeah, it's definitely, there's probably a link there somewhere, I'm sure. Thank you so much. I hope it was useful. I don't know if we've got time for any questions, in case anyone has any. Okay, we're going to have some lunch then, I guess. Thank you so much.